Rob, thank you very much for talking to us today. And you're going to tell us a little bit about MiFID II. The legislation comes in January 2018, and it's going to have various implications. And perhaps you can give us a context of how research is paid for at the moment so we understand what the implications are.
Sure. So the banks and the brokers currently provide their research and they don't charge for it up front. What they do is they distribute it to all their client base, and after the event, maybe at quarter end or at year end, they will then enter into discussions with their clients to work out how much they should get paid for that. And so for the larger fund managers, the likes of BlackRock, for instance, they will have a defined voting process. So their fund managers, their analysts will vote every quarter or every year, and they will distribute checks, effectively called CSAs, to the sell side based on those votes. But then there's also commission, another way of paying for the research. A broker will charge a certain amount, a commission, to execute a trade for a fund manager. So that fund manager will pay a commission, and within that commission there'll be a certain proportion for the execution of that trade and a certain portion for the research.
So how is MiFID II going to change everything?
So what MiFID II will do is unbundle that charge. So there will no longer be one fee that will encompass execution and research as well as other services that the banks and the brokers provide. There'll be separate line items. So you have to pay a certain amount for execution. You have to define how much you're paying for research. And again, that could be via commission through trading, or it could be through what's currently called a CSA. It's going to be called an RPA, but effectively a pot of money that gets distributed. And the critical thing for that is that through that unbundling, the fund manager will have to either pass that cost on to the end investor, so the pension holder who's holding his pension in their fund, for instance, and would have to itemize exactly how much they are spending on research, or they can take it onto their own balance sheet and pay for it themselves, but they still need to show how much they spent on research.
So how is this going to play out for the individual investor? How are we going to notice it?
So there's going to be different impacts at different ends of the spectrum. So I actually think on the whole, and for the larger, more liquid instruments like the large cap equities, for instance, it's a good thing, and it's long overdue.
What, FTSE 100 companies?
Yeah, the FTSE 100s, many of the FTSE 250s, and European and US securities. The amount of coverage that some of these companies have in terms of the number of analysts has been too high. Now, I used to cover oil and gas companies, and I was one of 35, 40 analysts covering a mid-cap oil company as an example. And fund managers don't need 35 opinions, and they're not going to pay for 35 opinions. So what you'll see is the amount of research coverage for the large caps will shrink to a more manageable level. Corporates will like this because the IR team won't have to manage 35 different analysts and their relationships with them. It might be 6, 7, 8, something like that. And so that's going to be a good thing for the large end of the scale. In the small end of the scale, so the real kind of small cap equities, it's not going to change that much in terms of it being primarily research written by either commissioned research houses or by the smaller brokers who don't get that much revenues from the secondary commission from the fund managers as things stand. But what we'll see is that mid-cap area will more of those companies will end up being covered by fewer and fewer analysts to the point where many of them potentially might not have sufficient coverage. And so things will take that place. Things will fill the void. I think commissioned research is one obvious example. But in that small to mid-cap end of the market, I think we could see a slightly too large amount of thinning out of coverage, which could have impacts on the volumes traded, the liquidity, it could have impacts on price discovery of the market. So could see more bubbles. There could be some negative unintended consequences at that end of the market.
So in terms of forecasts like revenue forecast, pre-tax profit forecast, earning per share forecast, are we still going to be able to get these as investors, or are they not going to be out there?
That is a quite topical, interesting question at the moment. A lot of the brokers I talk to are looking at a way of monetizing those forecasts. At the moment, it's an interesting situation where they effectively give those forecasts to the main data aggregators for free, so they don't really monetize those forecasts. Those data aggregators then create their consensus numbers and then monetize that with their end clients. I think what you might see is two things. I think you'll see that the brokers will want to, and the banks want to start monetizing those forecasts better, and so you could see prices rising for some of the services that use those broker forecasts, because that will get passed on by the main data aggregators to some of the other services. And you could also see that there'll be a thinning out of those forecasts. So you might get some companies where there is no consensus anymore, or the consensus drops to only one or two brokers where there used to be 5 or 6 or 10 or whatever it might have been.
So as an investor, you're saying we'll either have to pay more for them by paying for the research through whichever platform we use and probably paying more for that, or they're just not going to be there at all, no matter how much we want to pay for them.
Potentially. It depends whether it's on the small cap end of the scale, the smaller equities or the larger equities, and it depends on how things play out in 2018 post MiFID II, because there is still there are some, as I said, there are some brokers considering pulling their forecasts entirely from, so there are no forecasts from that broker going into consensus, going into the data aggregators.
And that's more at the small cap end?
Some of the small and medium-sized brokers are thinking that way. Other ones will still want to get their forecasts out there. There's no consensus yet about how things will pan out, but it's definitely a possibility that that the price will have to rise, because these brokers have got they've got cost centers, they've got headcount, analysts aren't cheap, and if you want to keep the business going, you need to find other ways of monetizing that headcount. And if it's forecasts or research, they'll need to look at all options.
So how's this going to play out with research notes that we get either from our broker or through Research Tree?
The way I think this will evolve is there'll be an increase in the amount of commissioned research, so research paid for by the company, and there'll also probably end up being almost two tiers or two types of research from the brokers, and there already are in many cases. You'll have your corporate research, which again is pretty much paid for by the corporate, still very valuable, but it's funded by the corporate. And then you'll have your research that is on companies that aren't necessarily corporate clients. I think what will happen is that the amount of commissioned research will increase, more new providers will crop up, and the current providers will increase in size. And that research will be available on services like Research Tree and probably on other sort of data aggregator platforms. What will probably shrink in terms of its availability to a broader audience would be the amount of research that is written on non-corporate client companies. And so what you may find is you have almost two tiers. You'll have a tier of research coming onto platforms like Research Tree, where if you meet certain compliance criteria, you can be considered to be an elected professional client and can subscribe. And that will largely be the commissioned research and a portion of normal, let's say, broker research. And then you'll have a deeper, broader pool of providers who are happy to distribute at a much higher price point, unfortunately. and that will be primarily selling into the fund managers, the buy side, and the wealth managers, those kind of clients. So there'll be a bit of a stratification, I would have thought.
So we've got Brexit coming up, and this is EU legislation. So is it all going to be irrelevant once we've Brexited?
Unfortunately not. The FCA were one of the main driving forces behind MiFID II. They have been heavily involved in writing that legislation, consulting on it, adapting it, iterating it, and they are not going to pull back from the upcoming legislation just because we're leaving Europe. And actually, if you want to do any business in Europe, you have to adhere to the same rules as are in place in Europe. So most banks and brokers are obviously not purely UK centric. They will want to adhere to European legislation so that they can sell into European client base. So it's not going to change anything, unfortunately.
So in summary, who are the winners and the losers of MiFID II?
I think one obvious winner is the commissioned research area, commissioned research space. There always will be a demand for research, demand from companies for research on them. And if that's not going to be picked up by the brokers, then it's going to be picked up by somebody else. So that's going to be a growth area. I think the relative winners will be the larger bulge brackets that have kind of that global research coverage. A lot of the global fund managers will probably gravitate most of their commission to those guys who are looking for global coverage. And niche providers of research as well. So there'll be some independent research houses which will do very well. Ones that are differentiated and offer a niche service that's not available elsewhere. The ones that are going to struggle are the ones that have a decent amount of their revenues currently coming from secondary commission, and that by most anecdotes and most people I've spoken to in the city on the buy side and the sell side are saying that research budgets are going to fall by about 50%. That seems to be the number that I'm hearing. Whether or not that's the case, we'll see, but that's the number that I'm hearing. And if you're taking out 50% of that, which is obviously revenue for a lot of these brokers, then that needs to be replaced by something. And so I think those guys are going to get squeezed.
And you think that will affect the smaller brokers? So the big brokers are going to be fine that cover FTSE 100, and the small brokers that cover FTSE 350 and small caps, AIM, that's going to be a more tricky marketplace.
I think the pinch point is going to come more in the medium-sized broker and some of the smaller, let's call them bulge brackets, rather than the small cap business model. The small cap brokers business model is largely funded by their corporate clients already. So there's not a huge amount of secondary revenue flowing from these large buy side companies into the small cap brokers in the form of commission. So that's not going to affect things too much. I think we'll see consolidation, which is needed, but on the small cap end. But in that mid cap and that small cap, small end of the bulge bracket, end of the scale, I think you'll see a big shrinkage of what has been a relatively material revenue line for them. So I think that'll be the main pinch point.
So in conclusion, for the private investor in small caps and mid caps, what's the net effect?
I think the net effect for investors in small and mid cap companies is that there's going to be less independent research available, which is obviously a negative. But there will still be research out there that is available, that is high quality, that adds value, which would be commissioned research. There won't be the same amount of research on many companies, so I think the number of analysts covering those companies will drop. But it's not going to be the case that we suddenly don't have any research to rely on. So it just suddenly becomes the case that there's far less research from a plurality of analysts rather than just one or two. If it's commissioned research, it's obviously more influenced by company management's expectations. But that still has a lot of value, and a lot of the good commissioned research providers, like Edison or Hardman or Progressive or Equity Development, they will detail the risks and the opportunities. So it's not like they're just talking the positive scenarios all the time.
Thank you very much, Robert, for such a comprehensive overview of MiFID II. We'll have to see how it plays out.
Thank you.